I walked up to the tower, and the man looked at me briefly, reached over to grab a scale, and placed it flat on the wooden deck. He said, "Get on." My family snickered a little bit as I stepped onto the scale. The man said, "Close call, but you're good. Just under the weight limit. Let's get suited up." I knew about the weight limit for the zipline tour, but something about physically stepping on the scale made me consider how many variables are involved in allowing me to safely soar through the Mexican rainforest. After my family slid down the first segment of the zipline, I stepped up and prepared to depart. The attendant tugged on my harness straps, clipped me onto the cable, and proceeded to yell, "Heavy load!" through the treetops to his coworker at the platform below. I could hear my kids laughing in the distance through the forest as I prepared to zip down to meet him. I safely made it to the next platform, and it turned out to be an enjoyable day of flying through the rainforest canopy. However, as you may expect, my kids still like to occasionally remind me about being a heavy load. Welcome to the first quarter 2025 market update. As we dive into 2025, we're in what feels like a heavy load market, and that there are more economic data and market variables to consider than normal. A newly inaugurated president, accompanied with an updated economic policy, uncertainty about future Fed funds cuts, inflation concerns, interest rate anxieties, volatile consumer confidence, and a transitioning labor market. While we step onto the platform and prepare to move further into 2025, it's important to examine some of the areas that are currently driving the market and consider what impact they may have going forward. President Donald Trump's return to office has sparked discussions about his potential impact on the U.S. economy. His administration is expected to implement several key policies that could influence economic dynamics across several areas: tax cuts and deregulation, trade policies, energy production, immigration policies, and more. We will learn a great deal about how this will unfold in the coming quarters. As I mentioned in last month's market update video, the December 2025 Federal Reserve meeting created a rare combination of events: cutting interest rates and disappointing the market. As expected, the Fed cut rates by 25 basis points, but they spent significant time discussing the potential to begin slowing future rate cuts, which created concern in the capital markets and negatively impacted asset prices. Chairman Powell remained steadfast in his claim that the Fed will remain data dependent, which means economic growth, inflation, and the labor market will remain front of mind throughout 2025. Headline inflation continued its slow move upward in December, with CPI coming in at 2.9%. Compared to 2.7% in November and a cyclical low of 2.4% in September, which is the third consecutive month of increases. Even so, the market considers December inflation reading a mixed picture, with consumers still grappling with high prices for essentials such as groceries, housing, and some services, while clothing costs have flattened out and apartment rental prices are slowly easing. The Federal Reserve continues to target a long-term 2% inflation rate. The yield on the 10-year Treasury recently moved to its highest level since 2023. That move has made the equity markets uncomfortable and pushed major indices down from record highs. This is a practical reminder that the bond market cares more about the future than the present. At this point, the bond market's concerned about potentially higher inflation ahead, along with a U.S. economy that may not need help from the lower interest rates. During the same period, short-term rates have also increased, but remain meaningfully below their mid-2024 peaks. Consumer confidence has rebounded from previous lows, supported by a resilient job market and steady wage growth, but remains below historical averages. Higher interest rates continue to weigh on borrowing costs, so it is possible that this dynamic could dampen consumer spending and business investment in the short term. While the U.S. labor market remains strong with continued job growth and low unemployment, it faces emerging challenges, including worker shortages, an aging workforce, and shifts in employer-employee dynamics. It should be noted that the current relationship between interest rates and the labor market and the equity markets is one where good news on the jobs front could be considered bad news for the equity markets. This may seem counterintuitive, but this paradox was highlighted in January this year when the stock market pulled back meaningfully after a strong December jobs report number. Many consider this outcome to be in response to investors being concerned that if the economy gains strength, that the Fed will remain focused on inflation and not feel the need to lower rates, thus potentially impacting the equity markets. As we climb on the platform and clip in for 2025, we continue to monitor this heavy load of data and how it evolves throughout the year. Regardless of market environment, investor sophistication, or access to research, we recommend that every investor consider the specific risk tolerance, time horizon, liquidity needs, tax situation, and investment objectives prior to making any investment decisions. Thank you for joining us for Q1 2025's Market Update. For more information, click on the link below.